Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending September 20th, 2024. So the Fed is coming out strong out of the gate, starting with a bang with a 50 basis points cut. That was the topic of the week. Now that we're looking forward to the next decisions, we see that, well, the Fed seems to have been very good at landing the message. Governor Powell, or Chair Powell rather, was good with communication on the week. We're starting with 50 basis points, but it's not. Don't think that this is going to be the pace that we'll be continuing at, but the direction has been set. So we'll discuss that in a minute. But the market seems to have understood the message and seems to have been satisfied with what it heard from the Fed. Before we go into the details here, maybe looking at the market action on the week. So, this is a very good year that we're having for equities so far. We're back to close to 24% in Canadian dollars for the US stock market. TSX up 16.4% on the year. Very strong year. EFI, emerging markets were strong. The bond market was a bit in a bit of a pullback this week because the market was repricing what it was, some of the optimism that it had about the pace of cuts from the Fed. So again, the message was well landed, but it had to be digested by the bond market. So a little bit of a negative return here. Gold remains the highlight for the year, above 25%, but it's getting caught up by the stock market is catching up in the US here, but it's still leading the way. So we didn't get into this decision with strong convictions. We didn't get in this decision with positions in portfolio to play a 25 or 50 basis point scenario. Market pricing was pretty much right in the middle, so the market was giving odds of 50% for each of these decisions here, 25 or 50 basis points. Finally, we got 50. So if we start here, it's an aggressive start. It's its first easing campaign in 4 years. We were still in the camp. We thought it was going to be 25 basis points, mostly because that seems to be the modus operandi of the Fed. And again, Mr. Powell at Jackson Hole in 2018 had a speech where kind of detailed that, in the case of uncertainty, you need to go with moderation. So that influenced us. And also remember that in 2022, when the Fed was clearly behind the curve and inflation was accelerating massively, they still started with a 25 basis point hike, and then they moved to 50s and 75s. But we got 50 here. It's clear that there's some catching up for the missed opportunity of July. And Mr. Powell was pretty candid with that. He was asked the question, and he said, well, if we had all of the information that we have now in July, they may have cut all initially in July. So catching up for that. He did say that the labor market is solid, and that was an important message he wanted to get across. Labor market is solid, it's not crumbling down, so they're not worried, they're not in a panic mode, and they say that they want to move swiftly here because they want to keep the labor market in a solid position. So that was the message from the Fed. It was encouraging. The market, I think, understood it pretty well. Where we're a bit surprised is that although he did say that, well, the trend has been set. Now we're going to be cutting from now. We're entering a cutting cycle, but they're not that aggressive with their target for the year end 2025. The Fed, the dot plot is pointing towards between 325 and 350 at the end of 2025. We think it's a bit high. We would expect them to go a bit faster than this and get to neutral much earlier than that. But that tells you that they still have a strong view on the US economy. Now, so the question is, well, there's lots of money that's been going into the money market. The latest data week over week that we see shows that there's still more data headed into the money market. Now, could money start coming out of the money market now that rates are starting to fall? And could this support risky assets? Maybe it's going to be marginally helping. We're seeing, we don't have a very long history, but when we look at the data since the early 1990s, I would say that typically it's when the leading rate falls below 2% that you have money coming out of the money market, and going into stocks and bonds, and we're far away from that. But let's see if this time is different. This should at least make the money market marginally less attractive compared to risky assets. So what's priced next? Well, if you look at the tables here, let's start on the left. For the next decision, markets are pricing a 25 basis points cut. But for the decision in December, markets are pricing another 50. When you look at the Fed, you look at the dot plot, well, there's two more meetings, and the market and the FOMC committee, so the Fed is flagging that we will end the year 50 basis points lower than now, so that means 25 and 25 quite likely. The market is pricing in 25 and 50 for 75 total. So there's still some room here for some volatility. So don't expect this debate to be over. There's still going to be some uncertainty about the pace of the Fed in the coming few months. If you look at 2025, as I said, and the chart on the right illustrates it pretty well, the Fed is the median of the dots is looking at between 325 and 350 by year end, but the market is much more aggressive than that, and you can see it on the table on the left that the market is seeing that we would be at that point, but in May rather than in December. So Fed is confident in the U.S. economy. Fed is sending a message that is going to be having a moderated approach, even if they started with 50 basis points. The market still wants more. So there's going to be some volatility around the views on the Fed. It will linger at least for the next few or maybe many months here. Now, turning to Canada, the inflation figures are at target for the first time since 2021. The pullback of inflation was pretty quick. Of course, there's some statistical issues here. We're just it's the comparison basis based on last year, the way that the inflation unfolded in 2023, that is starting to have some issues or some create some volatility on the year-over-year comparison. So, it's not crumbling down as quickly as we might think. When you look at the chart on the right, this is what we try to correct for. So we look at, the solid line is all the way to today, the year over year. And then we look at the scenarios looking forward. So if every single month starting from now, we had monthly prints of 0.4%, that would give you the red line, 0.3% every single month, that would give you the second line. And see, even if we have, starting from now, 0.0% every single month, that would still give you a rebound in the annual figure over the course of the rest of the year. And then after that, you have a wave lower in early 2025. And this is important because that means to everyone out there, expect the annual inflation figure to pick up over the next few months, based mostly on the statistical issues here. And Tiff Macklem, of course, Governor Macklem, knowing that, he addressed this in his opening remarks, said that, we might see a bounce in inflation by the end of the year, but still the direction is lower. So likely they will look through that, and that shouldn't really impact them in their decision. Now the question that we're asking this week, since the Fed cut 50 basis points, well, could the Bank of Canada accelerate and also cut by 50 basis points? That's the next slide here. So, Mr. Governor Macklem, in an interview, kind of raised the possibility. So I think it's mostly risk management framework here, saying that, well, if the economy deteriorates faster, of course, we're open to that. It was more that kind of a conversation. But of course, since the idea was raised, we were looking for clues in the summary of deliberations this week. And there was also a sentence there, a paragraph that showed that they did discuss again this possibility at the latest decision that they made, that if the economy is slowing down too quickly, labor market deteriorates, well, they could want to accelerate. So it's a possibility. Now, when you look at the markets, though, when the markets see a possibility, then they start to price it in. And for the next decision, which is on October 23rd, so it's in 1 month, markets are already pricing 50-50 odds. So 50% odds that we have 50 basis points of cuts, and 50% odds that we have 25 basis points of cuts. And you can make an argument for 50 for sure. If you look at the chart on the right, you see that the contribution to inflation now year over year, it's mostly all housing or shelter. We know that there are lags in those statistics about housing. The Bank of Canada spent a lot of time at the beginning of the year to explain that, well, sometimes you need to look through the inflation in housing because monetary policy is too blunt a tool. So you don't want to push the economy off a cliff because demography is pushing housing prices higher. So brings back all of this debate here. So you can make a decent case, and also if inflation is slowing down quickly, that means that the real leading rate is rising. So maybe it could be a good idea just to give a 50 basis point cut along the way, and just make sure that you keep the economy in the right place. So it's 50-50 for October. There's still a month to go, so we'll be discussing that for sure. The road to the US presidential election, maybe just to end, the honeymoon with Mrs. Harris continues. So she continues to rise in the polls, but it is an electoral college, so she likely needs to win most, if not all, of the swing states to win this election. And on the right, you see that in battleground states, while Arizona is still an issue, Georgia also is still an issue for Mrs. Harris. So Trump is leading in those states, but she seems to be detaching herself from Mr. Trump and having a wider lead in most of the other swing states. Pennsylvania was neck and neck recently. She seems to be polling well over there. So it seems that the race is getting more convincingly towards Mrs. Harris, but we still have close to 6 weeks to go here. So it's an eternity in politics. So what we'll be watching next week, in Canada, we'll have the CFIP business barometer. We'll have July GDP, which should be flat in Canada. So we should have another data point that confirms that the Canadian economy is stalling. This morning we had retail sales, which were pretty strong for summer month, but it was only the second positive month of the year. So there's a lot of data points to look at, and most confirm that the Canadian economy is still stalling. In the United States, we'll have the S&P Global PMI, should be higher for manufacturing, lower for services. Conference Board consumer confidence should be a bit lower, and core PC inflation should be flat at, stable at plus 0.2% month over month, higher 2.7% year over year. So nothing here to push the Fed into rushing into 50 basis points cuts at the next meeting. So that wraps it up for the week. Always a pleasure to serve you. If you like the content here, please share, and of course come back again next week.